Hi, everyone. This is Jason Burack of Wall Street for Main Street. Welcome back to another Wall Street for Main Street podcast interview. Today's special guest is a first-time guest. I've been trying for a while to get him on. I'm really happy he's coming on. He's hedge fund manager at Baring Asset Management with Bill Laggner. You guys have heard Bill Laggner do interviews over in King Roll News and Financial Sense NewsHour. His partner, Kevin Duffy, has also done interviews for the Mises Institute. So thank you for joining me, Kevin.
Thanks for having me, Jason.
Now, Kevin, I want to ask about your background a little bit. How did you find the Austrian School of Economics, and what advantages do you think it provides for looking at markets?
Yeah, actually, back in 1989, I was watching CNN's Crossfire with Lew Rockwell, actually Pat Buchanan, and he had on Lew Rockwell as a guest. And Lew was defending the Exxon and the Exxon Valdez oil spill. And so that's when I first heard about the Ludwig von Mises Institute, contacted them, started getting, and this was before the internet, so everything was done by mail. And a year later, I ended up attending Mises University, the 1990 Mises University. Murray Rothbard was there, Robert Higgs, Walter Block, and even Yuri Maltsev, who was an economist in the Soviet Union who had studied Mises. And actually had just moved back to the United States, or moved to the United States. So it was just a sort of a great intellectual foundation, and then I incorporated that into my investment process, my investment philosophy, which at the time was very much, it was value oriented and also very contrarian. So I found this as sort of the third leg to the chair, and there's just a lot of ways that it can help. I think one is just kind of a basic understanding of how wealth is created, the importance of the entrepreneur, especially the market entrepreneur versus political entrepreneurs, and I've tried to avoid political entrepreneurs over my career. There's also a lot of arguments about resources, and you get these arguments, are resources being depleted, peak oil and things like that. And I think the Austrian school is very much in the cornucopian camp, and so I think it can be helpful in that area. The business cycle is very important, and I think the insight that when you start distorting prices, especially the price for credit, interest rates, that bad things happen, and that we know that those things are not necessarily predictable. We can get price inflation, asset inflation, debt buildups, malinvestment. All kinds of bad things can happen, but not necessarily 100% predictable. I think there were when I got into this also, I made some mistakes, and I thought these might be important to mention, kind of the traps that I fell into. One of them was thinking I had discovered the Holy Grail, and thinking I probably overconfidence. And one of the things that the Austrians, especially the professors that I listened to through lectures, they kept stressing a certain humility when it came to forecasting, and I think I missed that. That was an important point that I should have paid a lot more attention to. But they basically they talked about the theory that that this is like a lab experiment, but you can't control. There are too many variables to control. So they would say, well, in theory, if all else is equal and you have price controls, that's going to lead to shortages. But in the real world, everything is not equal. There are many different variables, and so forecasting is incredibly difficult. And I think the other trap is falling into negativity. The damage that the government intervention does is very, very visible. It's kind of loud, and yet the human progress that's taking place, the positives, are less noticeable. And I think we all have a tendency I'm in a chat group for Austrian investors, Austrian leading investors, and there's a tendency to focus on the negative, and I think we lose sight of the positive. That's really important.
Yeah, I think those are great points. I think there's a lot of great entrepreneurs out there who are willing, despite these rules and regulations and taxes in the United States and other governments, they figured out rules away. Even the Soviet Union had, a black market where people were still trying to get goods that they needed and wanted and things like that. You brought up, though, about forecasting for the Austrian school. I think that's something, that the Keynesians and the mainstream economists, tend to bash the Austrian school for, but they don't really understand the Austrian school. The Austrian school is not really meant for, accurate forecasting. It's not meant for predictive. It's not doing models and things like that, like what Wall Street is doing. How, a lot of the Wall Street models, Kevin, they come out with all these different models. They almost always seem to be wrong. But the Austrian School of Economics, I don't think its main goal is to actually do like timing and modeling and things like that.
No, not at all. And Walter Block. This was after the crash, the meltdown in 2008. He wrote about those who had gotten it right, and of course they really predominantly came from the Austrian school, although they didn't get a lot of credit. And he differentiated in what he calls, not he, but the Austrian school refers to as praxeology versus thymology. And it's the difference between theory and the application. So as an economist, as an Austrian economist, they're supposed to really sort of defend the theory. These are the laws, the economic laws. These are the basic principles. And as far as governments, the advice should be, hey, you tread on these laws at your own risk. But Walter Block differentiated between the praxeologists, the Austrian professors, and the thymologists. These are the practitioners. These are the economic historians, and these are investors, and these are entrepreneurs who are trying to avoid errors. There's a lot of ways that so I think what Block was saying is let's not dismiss the value of trying to apply this. That's what an entrepreneur does every day.
Yeah, and I think the Keynesians, a lot of these Keynesian economic professors, they try to say, the Austrian school had predicted 6 out of the last 4 recessions. So that's right. Like the slight that they always try to say about it. But, to use a real world example of me learning the Austrian School of Economics and then seeing it in markets, I could see with China, with all their central planning and misallocation of capital, that they were just massively overspending, on infrastructure projects, on steel and iron ore and copper, that they had created just a massive amount of artificial demand in those markets. So, but the thing was the actually timing the trade and figuring out when those base metal prices, the demand, China was going to, cut back on their spending on those base metal projects, and the price for those base metals was going to collapse.
Yeah, exactly. And Jason, we saw the same thing, and timing is incredibly difficult. I mean, I think that's why you have to try to, and I've learned this lesson the hard way, is try to have a very balanced approach. Try to focus on the positives, but also be aware of the negatives. And I think the most destructive thing out there is for your wealth is a bubble, and I think you're right. What we saw really in 2009 after the meltdown was the Chinese. They kind of learned the game from the central bankers from Bernanke, and they were quick studies. And we had a huge money supply increased in China by 30% in 2009, and bank lending was up 100%, and we had this incredible boom. But I think also the lesson, the hard part is, once you see the risks out there with a bubble, and you can tell that there's something wrong with this picture, you have to translate that into well, how do I position myself? How do I invest? And timing is very difficult. We try not to get too caught up in the timing. I think that's where getting into the investment process is important.
Now, I want to ask you about your investment process. What investors do you pay attention to? Which ones have you learned from that you have studied, and how would you describe your investing methodology?
Sure. Well, first of all, we look at we think that aggregates are kind of a mistake. That's something that people kind of fall into this trap that looking at the market or the stock market. There really isn't a stock market. We try to. There's many markets within the stock market, and what we like to do is try to split it up into three segments, and it's not a static situation. I mean, companies can move from one segment to another, but so we look at first of all long-term secular waves, and I mean these are the positive things that are going on: the creative destruction, the entrepreneur at work, and companies that are basically riding these waves. And you have the big winners, and typically in technology, I mean this it's sort of a winner-take-all situation. So you have the whales, and then you have I kind of call it the whales and the barnacles. You have the smaller companies that kind of go along for the ride. So that's the growth area, and an investor that I respect a lot in that area is Ron Barron. Then you have the more defensive areas, and these are companies that are not cyclical. They have fairly high moats, and both of these first two segments, by the way, these are kind of the sweet spot in the market. These are permanent assets. You could think about Churchill Downs or maybe Vail Resorts or the Zurich Airport. Assets that are going to be around unless the people running them could certainly screw them up, but these businesses should be around for a long time, and they should be able to withstand a lot of different environments, inflationary environments and recessionary environments and that sort of thing. And then the third segment is sort of what we look at on the short side. Companies that they could be highly capital intensive, very dependent on credit, highly cyclical, highly dependent on getting financing, vulnerable to disruption from the secular waves that we just talked about. They could get caught up in a bubble, and they start drinking the Kool-Aid, and they're buying back their stock. They're taking on debt. It could be an area that's really hot, that's attracting all kinds of venture capital money and becomes highly competitive. And you also see a sort of whereas the defensive area tends to be businesses that are patient and kind of humble, but it's sort of the turtle building the business. These are impatient people, and I mean they need to make it fast, get rich quick, and so you see some aggressive accounting in that area. And so that area is people like Jim Chanos. I have a great deal of respect for Jim Chanos, Jim Grant. He's done a great job of generating some short ideas in the last 2 or 3 years.
Now, you're famous for your shorts. You did spectacularly well, I think, from 2007 to 2009 on the short side. Maybe not quite as well as Kyle Bass did, but, very well nonetheless. Your hedge fund that you run with Bill Laggner didn't do well, though, you were telling me, from 2013 to 2015. What lessons did you learn from your mistakes? And in hindsight, why do you think markets acted differently than you expected?
Yeah, wow. There were, I think, a lot of lessons. I think we got locked into, really not one scenario, but two scenarios. One was that, let's face it, let's go back to 2009, really that 2008, 2009 period. So you've got just this unprecedented expansion of central bank balance sheets, and something that we had never seen before. And we thought, as any good Austrian would think, that, well, this is going to end badly. This reminded me of what was going on in 1930 with all the intervention to try to stem the 29 crash, and we know that didn't end well. So yeah, I think one of the mistakes was locking into a scenario, and it was really then the backup scenario was, well, if asset prices inflate, we'll get an inflation a price inflation that goes along with it. And so our hedge was gold. And so here we are, we're shorting the market, and we're hedging that by being long gold and gold stocks, and the hedge is broke. I mean, what we ended up getting was a totally different scenario where all we got was an asset inflation. So so I think that was one of the lessons, that this is not inflations are not necessarily as predictable as you think they might be, and they're more predictable at certain times than others. I think back then there was sort of a blank slate, and it was very unpredictable. It's probably a little bit more predictable today, but to me the big lesson also was in terms of balance. We really focus so much on the negative, and I think that's one reason why I brought it up earlier, is that by focusing on the negative, we were, I think, guilty of confirmation bias. Everything you're doing is feeding that bias, all the information that you take in, and you're not paying attention to the positives that are out there. And there are a lot of positive things that are going on in the world, and there were opportunities along the way. And really it was about, and also aggregates. The idea of shorting the market. If we go back to 2005, 2006, 2007, we were focused on the credit bubble, and we were drilling down into areas where we thought were the most vulnerable to the bursting of that bubble. Like Fannie Mae, Freddie Mac, the home builders, the mortgage insurers, that sort of thing. And so when it played out, and the subprime lenders. So when things started to play out, we were positioned correctly. The problem is that what we ended up doing was we sort of substituted that for shorting the market. We had a big exposure to just short the S&P 500. Well, the problem with that is that you get everything thrown in there. You get the good, the bad, and the ugly. And instead of really drilling down and focusing on, well, these are the areas that we should be short. As I mentioned, there are three areas, three segments that we like to break the market into, and the defensive area. That's an area that you should never short, unless a company is, unless Procter & Gamble has a valuation that's 5% of the world's market cap, something like that, then you might go and short it. But,
or they get into subprime auto lending.
Yeah, exactly. If they move into the other pile, the other segment, then it starts to make more sense. But it's the drilling down. That was sort of maintaining balance, drilling down. Those are the things that were, and that's what we've tried to do. We've tried to learn from those mistakes, and we've tried to now, really spend a lot more time drilling down into short ideas and being positioned that way.
Yeah,
and
I think
also,
that's.
Yeah, and I was going to say also, trying to keep our eye on the long side as well, and try to have at least have some exposure there.
Yeah, to add to your points there, I think there's going to be some biotech stocks that come up with, cures to cancer and other very harmful diseases that there's been no cures for before. And if the market does have a major correction in the general indices, if the drug company, gets their drugs through the FDA, the individual companies are still going to do well. So there are some companies and industries with technology that are insulated from, general macro things. And, one thing I've also noticed with the general market indices, to me, Kevin, it seems like the people in power, the Federal Reserve or plunge protection team or whoever, it seems they want to really prop up, the S&P 500 futures. There's weird buying, right before the market closes. So I think the general indices are being defended when the technicals are about to go super bearish. It always seems like the technicals are reversed back to being somewhat bullish. But I think, individual companies are going to misallocate capital. The CEOs of companies are going to do stupid financial engineering, and there's going to be, companies that get themselves overextended and in trouble going forward.
Yeah, I mean, I'm not one for a big one for conspiracies. I just it doesn't really affect my thinking much. But I think if you look at the three segments of the market, it's been this reach for yield frenzy that we've had. I mean, every bubble is different, and you look at what happened in 2000. The frenzy in terms of the public. I mean, they were buying the .coms, they were buying the tech stocks, but they were actually selling the defensive names. They were, in fact, as the Nasdaq hit 5,000 in March of 2000, a lot of these stocks bottomed. I mean, Church and Dwight, Procter and Gamble. I mean, these stocks went down like 30, 40, 50% in the 6 months leading up to the peak in the Nasdaq. So it was a totally different market than what you have today, where the reach for yield, that's kind of what has gotten the public involved. And so I think that's what's sort of keeping the big averages up, and also stocks like Amazon.com and Google and Facebook, and some of that is warranted. I don't think that is as crazy as some of the .coms and some of the tech stocks in 2000.
I want to ask you about von Mises's crack-up boom. Since, we have the global economy, I think the fundamentals of the global economy are not really that strong, and yet asset prices keep going higher. Maybe I think your point about, people reaching for yield is correct. They're leaving other assets to go to stocks. But do you think that we're in the middle, we're in maybe the beginning then of a crack-up boom where people are starting to, leave their currencies that were in savings accounts, and they're starting to move that then into any asset price they can?
Yes, and I think this is going to play out in a lot of different waves, Jason. I don't pretend to know how this is going to play out. I'm sure it'll befuddle me, but I have some guesses on how it might. I think right now the first part of this is the malinvestment, and that we're starting to see cracks there, and so it should affect the stock market, the equity markets first. And especially those companies that are most vulnerable, that were sort of drinking the Kool-Aid. And but we also now have this fabulous bond bubble that's going on, and that's something that we didn't see this in 2007 at the top of the credit bubble. We didn't see it in 2000. So this is something that we're going to be dealing with. And then I think you're right. We're with the negative interest rate policy and $10 trillion in sovereign debt now at negative yields. There's an incentive for people to kind of leave the banking system and the government bond market and start to put money into gold. So, but my guess is that it's not going to kind of go in a straight line. I think we will have waves. I think we'll have bubbles bursting first. And my guess is that the real give up in the fiat currencies will come after those bubbles burst. I think it's sort of I'm not aware of any hyperinflation that takes place after an asset bubble. I feel like the asset bubble has to pop first, and we have to go into some kind of a depression in order to sort of pave the way for. Now, what happens if they keep on cranking the printing presses? and that new money does not go into asset prices anymore because the balloon has a hole in it, and so now you start to get price inflation, and that leads to hyperinflation.
Yeah, we have the Cantillon effects that Austrians read about. So the monies that the monetary inflation is not going to go evenly into different asset prices and consumer prices and things like that. A lot of people, on Main Street, even people, financial professionals who don't know Austrian School of Economics, they think that inflation is distributed evenly, but it's never really distributed evenly.
No, not at all. And I think that's definitely an Austrian insight, that there are winners and losers. If you're at the front of the line, then you will benefit from the inflation. If you're near the government and the government largesse that's being doled out, if you're at the back of the line, i.e., a saver on fixed income, you'll be a loser from that, essentially a wealth transfer.
Yeah. Now I want to ask you about the stock market. You said you were shorting it in 2013, 2015. But why, in your opinion, do you think the stock market hasn't crashed yet?
Well, I wish I knew the answer to that. I've been scratching my head the whole time, quite frankly. But my guess, and I don't know that I'm really going to be answering your question, but I mean, they have managed to just inflate a gargantuan bond bubble, and so that's been a strong tailwind. Of course, how did they do that? And I don't know the answer to that, quite frankly. It escapes me, but I think we're getting really close to the end of that. If we've got $10 trillion in sovereign debt at negative interest rates, and that's something like 30% of the total. But I do think that there have been the positives that have been going on, and companies like Google and Amazon and Facebook. I mean, some of that's real. I don't think you can call it all fluff. But I think most of it, quite frankly, Jason, is just this whole suppression of interest rates, the reach for yield, the blowing of the bond bubble, and the market has come along. I think I'm thinking of the catalyst in terms of cracking the equity bubble. And you look back at 2007. It was it was the credit area. It was first the housing prices started going down in the first quarter of 2006, and then the subprime bubble that really burst in the first quarter of 2007. So you had warning cracks. This time, the big driver of the global economy was China at the margin, and the bubble in commodities peaked in 2010. So we're now, if you look at this as sort of giving you a lead time, we've had a big lead time in terms of what's been going on in China and the commodity area, and now you're getting the marginal areas, the malinvestment, like the shale boom. You're starting to get all this happening, and it's sort of tipping over like dominoes. So we're getting, it's a process. This is not a monolithic event. It's always a process. It always happens in waves, and I think also there's probably a lot of conditioning that's gone on. The fact that bad news hasn't been reflected in markets, that reinforces a certain behavior, a certain, I guess, buy the dip behavior. And so, when the storm is approaching and it's right on your front door, maybe you don't do anything because for the last 5 years it's gotten close and it's backed away every time.
Do you think if the U.S. dollar and the dollar index had continued to strengthen like it had the last couple of years up until a few months ago, do you think that would have potentially accelerated a collapse in the global economy and asset markets then?
Well, I think one of the things is that the central banks, the balance sheets. First of all, I do think that the fact that the dollar has strengthened has been a sort of de facto tightening that's been going on. A lot of, and this goes back to the emerging markets, and of course that's a derivative of what was going on in China. If you look at the QE and the asset purchases that were going on by central banks, a lot of this was in 2009, 2010, 2011 emerging markets. And since that bubble has burst, that's gone away. It's sort of been replaced by the ECB, by the Fed, and the Bank of Japan. And now what you're seeing is the emerging markets are kind of going in reverse. Now they're having to sell assets. So it's all playing out, but so the stronger dollar is making it more difficult on any of these emerging markets countries, including China, that have borrowed in dollars. So yes, I do think that is being a catalyst, and it could be a catalyst if it continued.
Yeah, and I think that's why there was I think there's coordinated efforts by these central bankers, especially, the U.S., Japan, and Europe, because those are the developed countries and some of the largest economies. I think there's been, unfortunately, a coordination between, exchange rates and interest rates and propping up bond markets and things like that. I think there's just so much intervention now by central bankers into some of those key markets. It's just really got to be difficult out there to, understand the move of markets now compared to the past.
It is, but at the same time, you do feel like we're getting closer to this sort of Wizard of Oz moment, and this is a water-filled balloon. I mean, they can't keep it all together, and look at what's going on right now. And I don't know where the problems are going to come from, but I mean, there's so many areas that seem vulnerable. Look at a chart of Credit Suisse or Deutsche Bank. Look at the Eurozone banks, and you get the law of unintended consequences. They've pushed us into this negative interest rate world, and which has been great for the governments. They haven't had to pay interest on all this debt that they've accumulated. But the world has added $60 trillion in debt since 2007. 25 trillion of that from China. Total debt to GDP is over 280%. This is a record. We've never been there. And now the Eurozone banks are in trouble, and to make things worse now, you've got negative interest rates. There are a lot of problems, and a lot of these banks, because of Dodd-Frank and the response to the meltdown in 2008, there have been regulations put in place to determine risk-weighted assets on bank balance sheets, and so there are really strong there are disincentives from basically providing credit to small businesses, and there are huge incentives to provide credit to governments. So I don't know. I mean, when this bond bubble, this sovereign bond bubble, you've got Japan. 240% of GDP is government debt. I mean, it's just unbelievable. And here we are. The 10-year JGB is at zero or negative right now. When does this end? Where does it end? But I don't know. I mean, you've already got problems with the European banks, and they've got to be holding a lot of this stuff. So I'm skeptical that something's got to give. I mean, they've kept it stitched together with baling wire, but I can't imagine they'll be able to do it much longer.
Yeah, I agree. I don't know how much longer they can keep the party going with the asset prices keep going higher when we see the announcements about the global economy, the fundamentals with container ships and so many other, the oil tankers that are out there, so many other evidences that the global economy is not doing well. It seems with this financial repression that you talked about with the lowering of interest rates so these governments can keep borrowing and adding on more debt, just seems like they're taking on more rope to hang themselves with later, and they don't really care about the long term. They're just doing whatever they can to buy themselves, another 6 months or a year or two, and screw the long term consequences.
Well, that's the trouble with democracy.
Yeah, well, the status quo, unfortunately, is not good for a lot of people right now, Kevin. In terms of investing, though, where do you see value now on the long side for people who have some cash on the sidelines and maybe looking for an opportunity over the next couple years to maybe find something that has a moat, or maybe it's a good commodities play since it looks like the commodities maybe has started to finally rally and we've had a bottom in some of these commodities. Is there any particular industry you like? I don't care about specific companies, but any industry our listeners should maybe start researching?
Yeah, you know what? In basically looking at the two sweet spots, the growth area, the defensive area. The defensive area is very difficult. Again, very much unlike 2000, where there were plenty of opportunities, plenty of ways to kind of get defensive and prepare for any kind of a bear market. In fact, there was really a bull market in a lot of these defensive stocks. But today, with the reach for yield, not so much. So we've had to be a little bit creative. One area, looking in the commodity area, because of the bust there. Not all commodities are the same. You've got food commodities, you've got energy commodities, you have industrial commodities. So we like food, we like the food business, and in the commodity area, we like the fertilizer stocks. So one kind of, it's almost a mutual fund, Potash Corporation of Saskatchewan. They have long life reserves, but they also have investments in a number of other companies. So it's really a very diversified approach. There's a company called Phosagro in Russia, which looks interesting. I don't know that everybody is comfortable investing in Russia, but this is really a blue chip. And then there's a greenfield project, and the thing about Phosagro, they're in the phosphate business, and these deposits, you've got igneous deposits and sedimentary around the world, and the igneous ones are rarer, but they're purer, and so that has much greater value. And Phosagro has the biggest igneous deposit in the world. The Indians are consumers of fertilizer. They're right there, so that seems like a pretty good combination. Jim Rogers is on the board of Phosagro. And then there's another company called this is more of a speculation, company called Ariane Phosphate. They've really got it's the only greenfield project in the world that I'm aware of that is an igneous deposit of phosphate, and the stock's very depressed, and it's tiny, but might be worth a look. And then in the growth area, I'll throw out some trends, sort of long-term trends that we're bullish on. Genomics, Illumina is sort of the mutual fund. They're sort of the big whale in genomics. We don't own the stock, but that's something that's sort of on our watch list. Ecommerce, again, really no ideas there. It's not like this is anything new that nobody's aware of, but I do think it's a long-term trend. Cloud computing, the discount area, dollar stores. Again, no real position there, but something to watch play out. And there's in the healthy food area, there's a company called Natural Grocers. It's a fairly small grocery store chain, primarily in the Rocky Mountain states, and this is a company that was growing at 15-20% a year. The growth has slowed quite dramatically, and the stock has just gotten absolutely crushed. So it's a smaller stock, but might be worth a look. And then in the tech area, Patents are a big problem, and there's a company that's a patent aggregator called RPX Corp, the symbol RPXC, and they just did a big acquisition. Market didn't like it, absolutely crushed the stock. So that seems to be, if I'm going to sort of throw a value out there that might be worth taking a look at. Again, a small company, but they've got a lot of cash, no debt, or very little debt. So some ideas to throw out to your audience.
I just want to thank you again for your time, Kevin. I really appreciate it. And hopefully you'll be willing to come back on in the near future when markets move, and we could talk about, the global macro picture and the Austrian insight into these markets.
Sounds good. Thanks for having me on, Jason.